we think central banks are looking for a bit of clarity. One of the challenges they face is inflation is still a little bit intractable, and ideally they would not go full tilt into an aggressive hiking cycle. We're beyond neutral, but they need to see evidence of more of a slowdown that's pulling back inflation. And if you look at last Friday's employment report, it was very punchy. This week's, tomorrow's CPI report in the US will show probably a little bit of moderation in inflation, but I think a lot of central banks will want to see a lot more of that. We think they will in time, and we think that that will allow them to taper back the extent to which they're going to have to tighten. The backdrop of all that is, at the same time, earnings they're starting to roll over a little bit in terms of expectations. And we've seen that especially in US earnings. And that's not unusual. You see that coming into a slowdown, and they'll start to taper back. I think probably the market is digesting how much more of that is yet to come. With the linchpin of bond yields, where we've been quite low for the last couple of weeks on an anticipation of a slowdown, if that evaporates, it'll probably put more pressure on stocks. So we think there's probably a bit more news to come. There's a bit more of a challenge on the horizon for central banks. So we've a little bit more to work through here. So I think it's not surprising that the market ran out a little bit of steam in the last couple of days.
So Des, what's the strategy then? Do you hit the exit? Because we were talking to one hedge fund manager today who was saying this is a dead cat bounce and effectively still clearing out some positions.
It probably depends on your horizon. I think for someone who's a long-term investor, it can make sense to use strategies that dampen down your short-term impacts, whether that's more diversified, lower volatility, lower beta stocks, and looking at quality stocks. And for someone with a near-term horizon, they probably need to think about tail risk baskets. We ourselves have been overweight things like commodities and gold, which aren't a perfect offset, but they're a pretty good offset in this environment, and also being a bit underweight equity. So it depends on what your benchmark is and what your horizon is, but it's certainly worth thinking about some kind of tail risk, because we're in an unusual exit from a long monetary policy. And the challenge is today's monetary policy steps only become evident in the next year or two, their impact. So it's like trying to steer a car where the bend is a mile away. It's very difficult to judge. And in that environment, it probably makes a bit of sense to have some buffers in your portfolio, some way of counteracting that volatility that's coming through.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.